It's budget day on February 1st. And guess what? Something strange is happening. Corporate India, which is usually all about calling for more capital expenditure by the government, tax soaps and incentives for businesses, is now actually calling on the government to look at the state of the middle class, to take steps to create more jobs, and asking the government to ensure that prosperity trickles down to all sections of the society, particularly the mass market and rural households. If that itself wasn't surprising enough, the bigger 50 lakh crore or so rupees question is, will Finance Minister Nirmala Sitharaman listen? Let's break it all down in less than a few minutes. Modinomics, or whatever you may want to call it, India has been on an economic path in the past several years that is distinctly different from the previous 70 years or so. The strategy was simple enough. Spent massive amounts of money on infra projects, roads, expressways, airports, you name it, so that the system is flush with cash. And you know the nature of money floating around is that it all invariably ends up with big businesses, because they are the ones who are offering these construction services, building those roads, manufacturing that cement, steel, and whatnot. Now, Sitharaman and co were okay with it because the idea was that all this money in their pockets, India's private sector's animal spirits will be unleashed. They will expand with more businesses, construct more factories, and in turn, that means more jobs to the middle and lower middle classes and migrants from rural areas. That has simply not happened. Corporate India was showered with some of the lowest corporate tax rates in the whole world back in 2019. And the post-COVID Atmanirbhar Bharat policies meant there were a plethora of production-linked incentives in various sectors offering cuts and sort of cashback, to refer to a new economy terminology. But instead of reinvesting this money largely and creating what the government hoped would be a virtuous cycle where the wealth trickled down, creating jobs and stable households, leading to a robust economy, instead what happened was that many companies used the extra cash to line their pockets, with India Inc. operating on some of the highest profit margins during the 2022 to 2024 period. The argument for not investing that money and pay it back forward, so to speak, India's growth and particularly the demand for products from amongst the masses were not enough to warrant big capital reinvestment in new businesses, offices, factories, and offering more jobs. That meant India has been left, instead of a virtuous cycle, a sharp, not so virtuous cycle. The situation was exacerbated by the new economy boom, where professionals with specific skills, like in IT services and e-commerce, got paid handsomely. But there was an even lesser pie going around for the rest. Earlier, a farmer migrating from a village could hope to get a job in construction or in factories as cheap labor. But now the demand was growing in specialized areas like iPhone manufacturing, for example, or green energy businesses, all of which needed some level of specialized knowledge or training. Making matters worse, with steady jobs in traditional areas like textile and FMCG factories getting stagnant or even declining, thanks equally to mechanization and the emergence of new technologies like AI, as well as the fact that fewer people from the masses were spending much, considering the uncertainty over jobs. The result? Once the post-lockdown recoil, the whole revenge spending demand, whatever you call it, got over, and the rural economy and middle class suffering reached a point, it started reflecting in the GDP growth. Last quarter's rate of 5.4% shocked everyone. But the truth is that economy has been declining for a year now. All experts have cut short the predictions for GDP growth, with the new average hovering around 6.3 or 6.4% only. Now remember, GDP growth was over 7% in both 2022 and 2023, and over 8% in 2024. Now, coming back to Sitharaman, the big question is simple. Will she continue with the strategy of the last few years, spend big and ask questions later? Or will she give a thought to the rising clamor from the dwindling middle class to cut personal income tax rates? A call that is finding backing even amongst the businesses when they find that there are lesser consumers for their products. Well, don't get your hopes up, though some minor tweaking of the tax slabs is a possibility. In fact, the government needs more money with its welfare schemes and the likes of election promises only ballooning. So don't be surprised, instead of tax relief, the government only doubles down on fine-tuning the digitization of the financial system, which will make it even harder to evade dues and thus mop up even more from the existing small catchment of taxpayers. Not good news, I know, but let's just hope I'm wrong. However, the bigger question is what the government will do in the budget that can spur consumption, for which you need higher earning power amongst the middle class, which in turn needs an ecosystem for generating jobs. Even here, Sitharaman's hands may be tied, considering there were enough employment-linked incentives, skilling schemes, and even a program for interns that were announced in the July budget, some of which are yet to be implemented. Is she more likely to continue with the original strategy of big capital expenditure and awaiting for the virtuous cycle to kick in yet? Even if it's a dream that seems to be in dire need of a resuscitation.